is your order block. Now, if there is any wick or a tail, anything of that sort, you can mark that also as your order block. And as soon as the price comes back into this range, this is exactly where you have to buy. Now, why are you buying here? You are buying here because this is probably the entire region in which institutions kept on buying. Now, I will never know the exact price at which institutions have bought, but I can know a range in which institutions created their buy positions. So, for example, I may not know that this is the exact price at which institutions bought, or maybe there is this price at which institutions bought. I don't know. All I know is that in all probabilities institutions have bought in this range. So what will I do? Once I identify the displacement, I will mark my order block, wait for the price to come back, rebalance with a low volume dry up into my order block, and as soon as I get my candle confirmation, I will go long, placing my stop loss below the order block and a 1:2 or a 1:3 target, right? Now, this is way number one. This is the first way to identify an order block, body of the last red candle before the big displacement. And the other way to identify the order block is a narrow range consolidation. So sometimes you may not have a very clean body of the last red candle before the big displacement, but you may find very narrow, small range contraction kind of a structure. If that happens, this entire contraction, this entire narrow range activity will be considered as the order block. So at this point A, when you see that the price has created a displacement candle, your next step will be to mark your order block. You can mark it OB plus, meaning a bullish order block. Now set up an alert over here that whenever the price comes here, you get alerted so that you don't have to watch the stock all day. The stock comes slowly and steadily, and when your alert gets triggered, all you need to check is whether this rebalance happened with volume dry up or not. If it happened with volume dry up, you have your confirmation. If it did not happen with a volume dry up, the trade would be a little bit on the riskier side. Similarly, you can do the same thing on the bearish side, the body of the last green candle before the big displacement. Okay, so that's your green candle, the body of the last green candle before the big displacement. For the displacement on the bearish side, now we need the displacement candle to break the previous low. Once the previous low is broken and the displacement has happened, we will mark the body of the last green candle, and now we will wait for the price to come here, tap into the order block, and as soon as it does, we will go short with the stop loss above the order block and the target at 1:2, 1:3 or a 1:2.5. Now, important thing to remember, even when there is a correction like this on the upside, we will still need volume dry up as our confirmation. So remember that, right? So now what are all those steps? Let's quickly jump into that. First step, identify a displacement. A bullish displacement is a displacement where the previous high is being broken with good volume, with a good imbalance candle. And this imbalance candle could be one single big green candle, maybe multiple green candles like this, maybe a candle, maybe an inside candle, and then maybe a larger candle, and then maybe a larger candle as well, right? It could be in any shape or size. That's how you identify your previous high or displacement. The body of the last red candle before the big displacement is your order block. Let the price come here, then execute it. And similarly, for a bearish order block, you need to do the exact opposite. So what you need to do is you need to wait for the previous low to be broken. If the previous low is broken with a big candle, with big volume, and you mark the body of the last green candle as your order block, wait for the price to pull back into this range. As soon as you get a reaction, that's your stop loss. Your target is 1:2, 1:2.5, and then you can continue your journey forward. So the idea is very simple. We are not buying at any random place. We are first confirming whether this particular move was institutional in nature or not, number one. Number two, we are then identifying potential range in which institutions would have executed their order. Number three, we are then confirming whether the way in which the price is approaching the order block whether it is retail or institutional in nature. If it is retail selling, that means this selling does not have a lot of power, and for us to confirm that, we would want a volume dry up, meaning declining volume as the prices are coming down, right? Once we have that, we take the trade on the order block, set the stop loss below the order block, and the targets at 1:2 to 1:3. Now that all of this is clear, let me move you to a few examples here and there, and then I'll give you like a good idea. So I will initially start with stocks, and then I will move. So I will show you silver, I'll show you Nifty, I will show you Bank Nifty, I'll show you all of that. So first I will start with stocks, and then I will move to the index, I will move to commodities, I will even move to crypto, and then I will also try to cover real life case studies of where I have executed all of those trades. So now let's get started with examples for stocks first. Before I start, the time frame on which you have to do this is the 1 day time frame if you are a swing trader. Okay, so if you're a swing trader, the 1 day time frame, 15-minute time frame if you are a intraday swing trader, meaning you don't scalp, but you take like a 60 to 90-minute kind of a trade on an intraday basis. 5-minute or 1-minute time frame if you are a scalping intraday kind of a trader, right? So this strategy works across the markets, across any time frame. All you need to do is just check and cross verify if all the rules are being followed or not. With that being said, now since we have discussed the time frames as well, now let's move to examples of stocks, indices, commodities, and cryptocurrencies. So now let's start with examples. So the first example that I would take is Godfrey Phillips. The time frame is 1 day, right? Now I'll tell you why with stocks the 1 day time frame will fit in the best. Although you can use it for intraday also, and you can also use it for like a 15-minute or a 1 hour time frame. My personal favorite is a 1 day time frame, and I'll tell you why. No matter how much intraday trading you do here and there, the returns that you compare it with swing trading, especially with equity, right? If you're trading options or futures, yes, intraday is like a very good idea, right? But if you're trading equity, 1 day time frame is a really good idea in trending markets. If the markets are not trending, if the markets are only giving, maybe choppy moves, or maybe if the market is not clearly trending, then intraday works. So I'll give you some examples on the daily time frame, then I'll shift to other time frames. So you look at Godfrey Phillips, and let's try to understand step by step every single rule. Now, one thing to observe, you can see that the volume bars on my screen, right? The volume bars on my screen are actually gray in color. Now, what does that mean? This means that I don't really care if the volume bar is red or green in color, because I already know that for every buyer there needs to be a seller. So the volume color doesn't really matter. Only the intensity or the length of the volume bar is what matters. So over here, the first thing that I can see is over here. So there is an order block over here, which you can see that the previous high is being broken over here, right? So you can see one previous high is being broken over here, and then there's another previous high being broken over here. So let's consider this first, and then I'll come to this. So the first previous high over here, so I'll just basically mark this. So when the first previous high got broken, I'll just zoom in a little bit. The first previous high got broken over here. The body of the last red candle before the big displacement is my order block. I will extend this area, right? And I'll just color this area maybe orange, just so that you can understand that this is the area that I plotted. Then what I need to do is, once I've plotted this area, so when will I plot this area? I will plot this area as soon. Okay, so people who are texting me in the chat box, I can't see the chart. I am purposely only showing you the chart that you will actually see when you will be trading live. So when let's say today is the day when you're trading it live, right? You will only be able to see this candle. So once this candle is created, you can plot your order block. Give me a yes if you can do that. So the first check that you had to do is the previous high had to be broken. That is done. The second check was that this should have happened with the displacement long big body candle. That is also done. The third check was that this candle should have good volumes, and you can see that the volumes are just crazy and insane. And the fourth check is that when the price comes back, it comes back with low volume. So you can see the price comes back here and it comes down with declining volume. So you can clearly see that there is a simple volume dry up that has been happening with declining volumes, which suggests that there is no institutional selling. Now, what are you going to do? You're going to execute your trade right here when the candle closes. Your stop loss, I'm just going to zoom in a little bit, right? So I'm just going to zoom in a little bit. Your stop loss is going to be below the order block, and your target is going to be a 1:3. So I'll just randomly put up the target for here. Now, once you took the trade, and this is exactly the reality of trading, right? So as soon as you took the trade, the next day the price goes down. Now, what will most traders do? Oh my God, I'm having a loss. Oh my God, I will exit. Trading is bad. Blah 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 blah. The next day the price stays over here, and the other day the price makes a big move, but it gets rejected. Now what will retail traders do? Oh, there is a hammer, inverted hammer kind of a candle, and price is getting rejected from resistance or supply. They will create all sorts of these things in their mind, and what you will eventually see is that then the price stays very very flat for a decent period of time, and it's very very close to your stop loss. And the reason I'm telling this to you is this is the power of a system, right? So yes, the price did try to go up, but the next 7 days the stock has not given you any return. It's very close to your stop loss, but still hasn't hit your stop loss, right? The reason I'm giving this example to you is I don't want to show you picture perfect examples always, that price came here and it just rocketed past up. A lot of times this will happen. How many of you agree? Give me a yes or no. I'm trying to show you the realistic style of trading. So you may have entered on this day, waited for about 14 days, and there was no movement at all. And then the price suddenly takes off, and it takes off in a way that will blow your mind. After those 14 days of flat action, the price moved up by approximately 68% in the next 30 days. So overall, your trade duration was about 40 days, and you captured a 80% move. Now, if you trade intraday for the next 40 days, can you get a 80% ROI on your capital? Give me a yes or a no. Not possible. Absolutely. Why? So many transaction charges, buying, selling here and there, psychology getting displaced, and then the price just makes a crazy move altogether. Like, what a move! And it did not stop here. It actually made a high over here. So if I consider the high, the stock actually doubled up. It's 97% move in a matter of about 56 days from your entry. So 2 months, 100% move. 100% ROI on your cap. Obviously, you will not be able to capture this entire move. Maybe you take a 1:2 or a 1:3 or maybe a 1:4, and when you do that, your entire trade duration was almost, let me just count it. This is your day of the entry, this is the day of your exit. About 1 month of a holding period of about 29 calendar days, 20 trading days, because Saturday, Sundays are not trading days. So 20 bars or 20 candles, 40% move. That's the power. Now, since this move was created, we got another displacement. So now you see that the last previous high was also broken. So this is the displacement candle. This displacement candle, again following the same rules, had a big volume, broke the previous high, is a big body candle. Now if I remove this, now your order block is the body of the last red candle before the big displacement. And now, as I told you, if you do not have a clearly identifiable last red body candle, you can just mark the entire range